Well, hello, traders and investors. Today is August 26th. We are on a Wednesday, the last Wednesday of August. September's right around the corner, and we've got a lot to talk about today. Now, yesterday we've had two pieces of data. We had consumer confidence and new home sales. Consumer confidence was terrible. I mean, the news was bad. It wasn't positive at all. The consensus was 93. We came out with 84. And the range was 88 to 94, and we went below the range. So consumer confidence is not good. Now, the reason that's important is because we've got GDP on Thursday, and GDP is the biggest report of the quarter, and it's going to tell us how much we grew or sank. That's not good. On the good news, we had very, very positive new home sales. I told you guys about 2 months ago that basic materials and new home sales were going to go through the roof. And I was right. As usual. I'm not always right, but in this case, I was dead on. I mean, if you look at the new home sales numbers, they beat all expectations. Again, an existing sales, not actual, was 901. The highest expectation was 800,000. We had 901. That's huge, huge. Home sales are going through the roof. Now, I'm expecting the markets to be subdued today. Why? Because we've got GDP tomorrow. Not because of the jobless claims. Because we've got GDP and we've got Jerome Powell, and Powell is going to be talking about the future of our economy. Now, are there going to be any changes in store? I don't think so, especially with Powell. This Fed does not know how to hold anything close to their chest. They tell us everything. They literally tell us everything as far ahead as a year, which is not something the Fed is supposed to do. They should keep things close to the vest. But again, I'm expecting a subdued day because we have GDP tomorrow and we have Mr. Powell talking. And we've got new home sales, but that number is going to be better than expected because home sales, because of low interest rates, and people have been putting money back into their house. So existing home sales refinances have been going through the charts. Now, let's talk about global markets a little bit. Global shares were mostly lower Wednesday as investors looked ahead to a much anticipated speech. That's happening tomorrow. Data released is giving a mixed bag of signals, such as a relatively positive U.S. home sales, but a disappointing read on consumer confidence, which is what I just told you. Most market players are watching for Fed Chair Jerome Powell's speech on Thursday. I guess I didn't really need to go through this because we just covered all of it. It's very difficult to predict how things are going to go. Central banks slashing short-term rates. We don't know how much more money the Fed is going to put or central banks are going to flow into the market. Crude oil is right at that breaking level. If it goes just $1 or $2 into the toilet, then energy prices are going to be bleeding because it costs energy companies in the low 40s to buy a barrel of crude oil in America. So right now they're kind of like at a break even. They're not really making money right now, but they're not bleeding a lot of cash because they can make a little bit money of crude oil. But if crude oil prices goes down, they're going to have to buy for less than what they sell. So that's not a good situation. And this is why I keep looking at crude oil prices almost on a daily basis and reminding you of them. Now, looking at the stock market's going higher. I've been talking about a massive divergence, as you could see here. The lows, the RSI levels here, you could see is higher, lower, lower, higher. Even if we expand it and take it all the way up to here, which we probably should do, it doesn't really change anything. We've got higher highs, lower lows. That's divergence. In addition to that, we've got RSI level almost at 80. Folks, do you know how hard it is to get the RSI to move up to 80? That's telling me that that rubber band is stretched out. Now, to give me some confirmation, and this is important, and I want you to pay attention, close attention. This is the put-to-call ratio. This is the overall put-to-call ratio. This tells us how bullish option traders are versus how bearish they are. Typically, when option traders please pay attention. This is important. I mean, really important. This is one of my top 3 indicators. It's usually useless and random, but when it's not, oh man, it's deadly accurate, like right now. So when the number of calls bought is extremely high in comparison to the puts, the put-to-call ratio goes really low, like it is right now. We're near historic lows. I mean, let me go further in price. Let me go to 6 months, just so you could see how low this thing goes. Look at what happened in June. Look at how it bounces every time it goes into the 60s level. But let me go a little further so you could see how low this number is. Notice we hardly ever go down to these levels. And every time we go down to these levels, we bounce, we bounce, we bounce. This is telling us that market traders are getting a little too exuberant for their own good. I mean, just look at the S&P 500. We continue making all-time highs when the market momentum levels are telling me, we're done, we're done. It's like a rubber band that just keeps getting stretched out. But again, that's all good and fine. But when the put to call ratio gets below 70, that means the ratio of calls is too high. That's like putting beginners who've never traded into in the market, giving them a lot of money, knowing that they're going to bust out. That's where we're at right now. This is where bulls are just plowing money into the market with blindly just going and forgetting all sense of fundamentals and technicals and momentum levels. Because folks, momentum levels, and I've been talking about momentum levels almost every day this week, they're not pretty right now. So the put to call ratio is at 62. Now, you see this number when it gets to 180, 170, even right here, 120, that's when the market gets overly bearish and it bounces back up. But now the market is overly bullish. Notice how the put to call ratio has been moving lower, 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 lower. The market has been favoring call buying. But again, once the level gets to the 0.60, 0.70, 0.62, it's that rubber band is just stretched too much. So I'm expecting a market cool-off sessions, partly because the put-to-call ratio is favoring the calls by such a large margin, all right? And again, most of the time, 90% of the time, this indicator is useless. It's noise. The only time I really pay attention is when it gets above 120 or when it goes below 70. And right now, it's at 62. That's a very, very bullish, and that's a very, very bearish indicator in terms of what it's going to do, but in terms of the market sentiment, it's a very bullish indicator. It's telling us that the number of calls is outperforming the number of puts to such a degree where the market needs to turn. Now, again, this indicator is usually random, so you only want to pay attention to it when it's really, really low, like below 70, or above 115, 120. Below 70, it's telling us that there's too many call traders. Above 115, above 20, it's telling us that markets are getting too fearful. So here, below 70, markets are too greedy. Above 120, markets are extremely fearful. And when markets get too fearful, they switch back. When markets gets too greedy, they switch back. So again, most of the time, this rubber band is kind of in its fluctuation. But when it gets too stretched out, when it does, it's at 115, 120, or 0.70 or lower. And folks, it's stretched out right now. Let me show you something I've been showing you for God knows how long, but I want to show you this again. If you look at the overall stock market, only 51% of stocks in the overall stock market are trading above the 200-day moving average, okay? So the market is not as bullish internally as it looks, but the S&P 500, the S&P and the NASDAQ, let me look at the NASDAQ so you could see what I'm talking about. Let me look at the NASDAQ 100. Look at these momentum levels. 77% of stocks trading above the 50-day moving average, and it's overdone. See, momentum levels, let me go here. Look at momentum levels. We had 98% of stocks trading above the 50-day moving average. Now we have 77% of stocks, but price, let me go to the QQQ, continues to make all-time highs. Look at that. And we're seeing major divergence. This is what I was showing you. This is pre-COVID. Higher prices, divergence, we break down. Higher prices, divergence, pow. It may not happen this week. It may not happen next week, but it's going to happen very, very soon. We're overdue for a correction. And again, when the put-to-call ratio gets to this level, watch out. Look at the level it went to in February. And look at the after the crash. This is pre-crash, post-crash. So again, we're lower now than we were in the COVID climate. So I'm telling you, we are overdue. Maybe a 3-day pullback, maybe a 2-week pullback, but the markets are overdue. The put-to-call ratio is hardly ever wrong when it gets to these levels. Pay attention for it. Pay attention to it. And most importantly, have an amazing day. But folks, get defensive. It's time to get out of tech, move into basic materials, move into construction stocks. Just do all the stuff I've been telling you for a month and a half, 2 months ago, and you should be fine. All right, I've got something for you today. Most folks don't know this. They really don't. But Wall Street runs on a secret calendar. Think about pension funds that have billions of assets, and they have to reallocate it into equities. They can't leave it into cash. So they don't care about markets going up or down. They just put money into the market on a secret calendar. They trade the same stocks on the same date every year. Tom Busby and I have proven it. Thanks to this calendar, it doesn't matter if a stock's been struggling or if market conditions are terrible. When that date rolls, the stock goes up. It's just that simple. Now, all you need to know is when the stock will skyrocket. You need the date, and you could have potential to score weekly payouts of 357% or more on the decade. Tom Busby's proprietary dashboard alerts him when a stock's prime window is approaching, and that's what it's called. It's called a prime window, and he wants to give you access. Folks, check this out now. You're going to get 10 free picks just by checking this out. You don't want to miss it. We're going to give you 10 dates that were accurate over the last decade for 10 stocks. You really cannot afford to miss this. We recently had as many as 10 winners in a row with one loss and a scratch. You really need to check this out. Don't wait around. Click on the link below to get access now. Do it now. Most importantly, have a great day. And folks, I need your feedback. If you want me to cover certain articles, let me know. If you've got something bad to tell me, let me know. If you love me, if you hate me, if you can't stand me, if you don't like my polo shirts, let me know. Send me an email, support@marketgeeks.com, or just post a comment below and I'll respond. I promise. If it's a reasonable comment, I'll respond. Talk to you guys soon. Have a great day, and keep your eye on this put to call ratio. This rubber band is stretched out to the tilt. Bye, guys.